The very concept of money is undergoing a profound transformation. For centuries, we have relied on physical cash and bank-led digital entries to conduct our economic lives. Now, two powerful digital forces are emerging, each promising to redefine how we store, send, and perceive value. On one side, we have central bank digital currencies, or CBDCs, digital versions of a country's official currency, like a digital dollar, digital euro, issued and fully backed by the central bank. On the other side of this digital coin lies the world of cryptocurrencies, privately created digital assets not issued or controlled by any central authority. To understand the future of money, we must first grasp how these two systems operate, because their foundational structures are worlds apart. A central bank digital currency functions through a centralized model. Think of it as a digital ledger managed and controlled by a single entity, the central bank. When you make a payment with a CBDC, the transaction is processed and verified by this central authority. The central bank would have the ultimate say over the rules of the system, including who can participate, how transactions are settled, and how the digital currency is issued. This structure mirrors the traditional banking system, ensuring stability and trust through its oversight. Cryptocurrencies, in stark contrast, operate on decentralized networks. There is no central server, no single administrator, and no one in charge. Instead, assets like Bitcoin and Ethereum are built on a technology called blockchain. The technology that powers a CBDC is fundamentally about control and efficiency within a known, trusted environment. A central bank would likely use a form of distributed ledger technology, but it would be a private, permissioned version. Permissioned means only authorized participants can validate the ledger. The central bank, designated financial institutions, validate transactions and maintain the ledger. This closed-loop system gives the central authority full oversight, can enforce rules, reverse fraudulent transactions, and comply with regulations. Anti-money laundering, know your customer. Focus is not anonymity, but identity and accountability. Cryptocurrency technology, on the other hand, is built for a trustless environment. Blockchain's core innovation creates consensus among strangers. Proof of work. Miners compete to solve complex puzzles. Winner adds the next block and earns newly created coins. Requires immense computational power. Proof of stake. Validators stake cryptocurrency as collateral, selected to validate and earn rewards. Misbehavior risks slashing. More energy efficient and scalable. Both approaches secure the ledger. POW via cost energy, POS via economic incentives and staking. Both rely on game theory to keep participants honest. Both provide secure, accurate ledgers without a central authority, but they choose different technical trade-offs. Despite their foundational differences, CBDCs and cryptocurrencies share some important similarities. The most obvious, they are both purely digital forms of value. They are entries on a digital ledger, accessible via smartphones or computers. Payments can be faster, more convenient, and more efficient, potentially instantaneous, 24/7. Cryptography is essential to both. For crypto, cryptography secures wallets and signs transactions. For CBDCs, it protects user accounts and central ledgers. Both aim to improve cross-border money movement. Today, it's slow, expensive, and opaque, often involving multiple intermediaries. Some cryptos, like XRP, were built for cross-border transfers. Central banks explore wholesale CBDCs for instant interbank settlement at lower cost. That shared ambition is a powerful point of convergence. The rise of crypto pushed central banks to rethink digital currency. CBDC development pushes crypto to innovate. Innovations in one space spur the other, two sides of the same technological revolution. Each pushes the other to define purpose and prove utility in the evolving financial landscape. So, the most significant difference between CBDCs and cryptocurrencies, honestly, comes down to their philosophy of control. A CBDC is like the ultimate expression of centralization. It's issued, controlled, validated by a single entity, the central bank. That means the government has the final say on the rules of the system. They can set transaction limits, freeze accounts suspected of illicit activity, program the money with specific conditions, like making stimulus funds that expire if not spent by a certain date. Cryptocurrencies are built on the opposite principle, decentralization. Assets like Bitcoin are defined by their lack of a central controller. Protect your private keys, then no one can seize your assets. This gives users true ownership and control, or stop you from sending them to anyone, anywhere. That's financial sovereignty. Another key point is identity and privacy. A CBDC would almost certainly not be anonymous. Users would likely tie wallets to real-world identities to comply with regulations. Cryptocurrencies are pseudonymous. Transactions visible but addresses not names. Forensic analysis can sometimes de-anonymize users. Privacy coins obscure sender, receiver, and amount. Privacy is core to the crypto ethos. So, the advantages of a central bank digital currency are, honestly, all about efficiency, inclusion, policy effectiveness. For users, a CBDC could mean faster payments, cheaper payments, and inclusion for those without bank accounts. Imagine getting a government payment or your salary instantly, with no waiting for bank processing times. Central banks could more directly influence the economy, adjusting interest rates on CBDC holdings, distributing targeted stimulus. A CBDC would give the public a risk-free digital asset, a direct claim on the central bank, which could reduce bank-run risk. It could spur competition and innovation by creating a public platform private companies can build on. But the disadvantages and risks tied to CBDCs are pretty major, with privacy being the biggest red flag. A CBDC would give the government a direct window into every citizen's financial life. The data could be used to monitor spending, track political donations, or enforce social policies. Programmability is double-edged. Governments could block purchases or make money expire, turning money into a tool of social engineering. If people hold cash in central bank wallets, banks could be starved of deposits. That could disintermediate the banking sector. That would reshape the financial landscape, concentrate power, create a single point of failure, and require extremely careful management. The main thing that draws people to cryptocurrencies is, honestly, the financial freedom and sovereignty they offer. In a world where access to money can be restricted, crypto gives you a permissionless alternative. Anyone with internet can set up a wallet and receive funds, no matter their nationality or credit history. Crypto can be a lifeline in unstable economies, protecting wealth from hyperinflation and moving it across borders when controls clamp down. DeFi rebuilds lending, borrowing, trading, insurance on open protocols, no middlemen. Non-stop experimentation is pushing new economic models and tools nobody imagined a decade ago. Still, freedom has a high price, extreme price volatility. Cryptos can swing wildly, making them unreliable as a daily medium of exchange. Lose your private keys or send to the wrong address. Your money's gone. No one to call for help. You shoulder the responsibility. Crypto exposes people to hacking, scams, and manipulation. Scalability challenges can make networks slow and expensive during spikes, limiting everyday usefulness. The arrival of CBDCs or broader crypto use would shake up every level of society. For individuals, the changes could be huge. A CBDC could bring convenience, security, and make basic services available without a traditional bank account, but privacy could take a hit. For commercial banks, the future is uncertain. A retail CBDC could make banks obsolete at holding deposits and processing payments. If people park money with the central bank, banks lose funding and their ability to lend, hitting mortgages, small business lending, community projects. Banks would have to reinvent themselves. Wealth management, complex lending, user-friendly CBDC interfaces. Governments would be transformed. Unprecedented insight into the economy, easier policy implementation, more tools to fight financial crime and deliver relief. But it also brings massive operational and cybersecurity burdens. Central banks become managers of critical national infrastructure and prime hacker targets. Crypto challenges government authority. Regulators must cooperate internationally and build balanced frameworks to protect consumers while not killing innovation. The future will be a balancing act. Curb the worst of crypto while exploring digital currencies to keep public finance competitive. Regulators, startups, and policymakers must protect consumers, preserve stability, and not stifle innovation. Crypto and CBDCs are two waves of disruption. The challenge is managing both. Looking ahead, it's pretty unlikely there'll be just one winner in the race for the future of money. What's more likely is a complex, fragmented ecosystem where different digital monies coexist and serve different purposes. One future, CBDCs become the backbone of domestic payments, digital cash that's safe, reliable, and run by the state. People use them for everyday transactions, paying taxes, and receiving government benefits instantly. Crypto could carve out durable roles. Bitcoin is digital gold, a store of value. Ethereum could remain the backbone for DeFi, digital assets, and global compute for decentralized apps. Other cryptos could focus on privacy or super fast, cheap cross-border payments. Interoperability, bridges, and APIs could let people swap CBDC, BTC, and ETH seamlessly in a single wallet. Someone might get paid in a CBDC, convert some to Bitcoin for savings, and use another chunk in DeFi, all from one wallet. The future of money will be shaped by technology, regulation, and what people actually want.